Good afternoon, everybody. Yes, welcome to my channel. It is me, the Millennial Investor 1914. We are here to talk about investing. Of course, you guys know, right? You guys already know why you here. We have a treat. In my last video, I kept it simple. I kept it simple. I went back to the mean, started over, and really talked to everyone, and had a video about just how to invest for individuals who uh, don't know what they're doing. I have some friends and family members just like, man, stocks is foreign. When they look at the stock market, they're like, man, I don't know where to start, or I don't know how to create generational wealth. And so my last video, we kept it simple. We didn't go into details because we all know that it is me, numero primo, your boy, your boy. I am a dividend growth investor. Yes, I've completely revamped my portfolio, and I've issued a new strategy. My dividend portfolio, as you see right here, my yield used to be at around 3.5%, which is pretty awesome. But why it being at 3.5%, I also actually had a dividend yield hovering around 10%, which is really good. But I recently have took a step back because I want to retire at age 50, and I need share price appreciation. I need for a my portfolio to grow and compound fast, at a high rate, so that I can sell some of the low shares of stocks and dump some of that into the higher paying dividend stocks that's consistent down the line in 15 20 years. And so last video was really more so how to keep it simple, how to create that generational wealth in investing just by focusing on VU and QQQ. And if you don't like VU, you can do VTI and then just invest that way and stay consistent. But for the mature investors and for the individuals who like stocks and like a lot more risk, like Bitcoin and juicy MPWR, monolithic power, or Eli Lilly, then this video is right for you. Let's dive in. This video is all about the dividend snowball effect and how to make your money work for you. Most importantly, how to make your dividend income, passive income, work for you. We're going to go through my portfolio right here. In this portfolio, I have 20 holdings, and as you see, my top holding in my portfolio is Microsoft. My top five is Microsoft, Apple, Broadcom, Kroger, and Snap-on. The What you'll see is right here the dividend growth. Microsoft 10%, Apple 4.3%, measly, but Broadcom 14%, Kroger 12%, Snap-on 15%. Home Depot just increased their dividend by 7.7. You have properties 6.4%, McDonald's 9.9, Chevron 7.9, and as you see as I go down, a majority of my stocks are in the double digits, or at least close to 10%. I'm wanting to compound my wealth fast, and that's what leads to the dividend snowball. The dividend snowball starts off small, you stay consistent, and then there's three levers. It's you putting money into your portfolio, it's your portfolio dividend growth income growing uh, just automatically due to the dividend raises, and the last lever is reinvesting the dividend. So you receive the dividend, reinvesting back to the stocks or stocks if you're choosing. Then you dump in new capital into your portfolio. That's how it grows. And then also by you reinvesting, that's a third lever. What you'll see is that it's the end of February. So February, I've recently right here, I've been dumping roughly a thousand to 1,050 per month starting this year. The next month, I plan on dumping 1,500 into my portfolio. I might actually dump another $1,000 depending on my incentive paid by my job. If it's around 2,500 or 2,600, I'm going to dump another 1,000 into the market and put some into Waste Management, American Express, and Texas Roadhouse. But as right now, we're just only stick with 1,500. And as you see here, the breakdown. The dividend snowball effect. I just showed you guys what I plan on doing next month I'm accelerating dumping money into my portfolio because I'm trying to have this portfolio hit 100,000 so I can really start the compound interest. But this is the juicy part right here. Here's market beat and market beat dividend calculator. Right here, I can put. Actually, I want my stuff. It's gonna be compounding quarterly, so I'm going to press calculate. Your boy. All right. So we starting out with an A. Portfolio balance of $52,230 with a annual contribution of $12,500. That's with me essentially investing roughly $1,000 per month, and so I'm looks like I'm going to be contributing a lot more. Looks like I'm going to be contributing around 15,000, but I just want to keep at $1,000 for now, just to keep it clean. My portfolio balance, portfolio dividend yield is at 1.94% with a increase of 11.5. You see right here, my increases for the last 5 years have been at a 12.4% clip, but I just want to keep it on the conservative end. And the share price appreciation, if I was to open my Fidelity, you will see that my portfolio has been around 16% the rate of return, which is not bad. I'm hoping I'm trying to get up to at least 20%, but beggars can't be choosers, or at least 18%. But I'm getting to the bag when I revamp my portfolio, and when I had a big chunk of my portfolio in All Group. I was receiving a lot of dividends, but I saw that I wasn't receiving a lot of share price appreciation. That's why now you see my top five. You see Broadcom, you see Microsoft, and you see Apple, and then also Snap on, and then Kroger is more so a money play than growth play. So my strategy is actually working, and so you do it for the next 30 years, and voila, you see. I like seeing this graph, right? So with this graph, uh, in let's say 15 years, because I'm 35 years old. So 35 plus 10 is at 45. It's projected that my portfolio balance will be at 424. Uh, so in 15 years, my portfolio balance should be at uh, $884,000, which produce a dividend income of 14,000. That's a lot low, but we're going to make it work. If I was to continue to let this ride for 30 years, you see my portfolio will be producing 97,000 and will have a portfolio balance of 6,000, 6 million. Tongue tied, right? And then there's right here, uh, boom. I'm definitely close to the $1,020 right now in regards to annual dividend income. But the most important thing about this that's important is that my portfolio balance is increasing. And at year 15, it's around 767,000. Year 17 is at 1 million. And I'm investing into these low yielding stocks of, as you see, I'm going to show you guys right here real quick. I'm investing into a lot of low yielding stocks, and these low yielding stocks is going to grow fast. I have Apple, I have Costco, I have Microsoft, I have American Express, Waste Management, Bro Rich, Caterpillar, Williams Sonoma, Broadcom, and that's this for now. I'm also planning on adding MCO, which is uh, it's the MCO is the exchange. I forgot what it's called. Moody's. I plan on adding MCO next year. Moody's, and I plan on adding Vanguard's high dividend paying stock next year. And so my portfolio is going to be very diverse in regards to adding that Vanguard high dividend ETF and Moody's another low yielding stock, so I can definitely get the compound my wealth, compound my rate of returns, and hopefully get my rate of return to roughly like 18% per year. That is good because I need that, have my portfolio compound at 18 to 20% for the next 15 to 20 years so I can be able to hit my goal on top of my dividend income increasing. And right here, the goal is that once I have these low yielding stocks to compound and to grow ridiculously, then I can not sell the whole thing, but probably just shed some off the top of Microsoft, Apple, of Costco, most definitely Costco, because Costco's a grower, waste management, brokerage, and then put it into more of the heavy paying, heavy high dividend paying stocks like EPD, ARCC, I already have Mo, but probably little bit more Mo and OBDC. But I would still also let the low yielding stocks let it continue to compound, let it grow. I wouldn't sell the whole thing because I still need the portfolio to grow and to outlast me and to grow past me, so it can grow past the years on years. But at the age of 50, 55, I'm going to need more income than growth, and then I probably add JEPI to the portfolio or realty income. And so with that, right now I'm in wealth accumulation stage, growth stage. And since I'm a dividend growth investor, I like stocks that grow really fast, that has low yields, but also pays a reliable dividend, increase their dividend every year reliably, but also is going to add at least 10 to 50% rate of return increase on a stock. And this is just my dividend growth portfolio. I have another like growth portfolio that is really main focus on growth, but it has dividend paying stocks. Uh, and I love it. So that's the goal. This is the snowball effect, how you let your dividends compound and grow for generational wealth. The passiveness of the dividends, you reinvest in itself. You add more capital, and when you think about it, it's taking snow from the ground. I'm from Wisconsin, so it's like you take the snow from the ground. It's a soft snow. Then you get more snow. You add it. You add to it. That's the new capital. You doing this to the snowball. That is the reinvestment of the dividend, and then boom, and then the snowball that you pack in, you doing it. See the visualness of the snowball getting bigger. That is your portfolio actually growing with the dividend increases. When you are leveraging all three levers, you end up with a portfolio that's in the millions. And there's like many different uh, YouTube creators that's dividend investors, like Gen X investor. I look at his videos that he put out every Saturday. Shout out to him, and he's a great motivator of having uh, a 7-figure portfolio that's producing like 6 figures, 8 or 5 figures, high 5 figures of uh, like 80, 85,000, 95,000, and living off of it through passive income. And then he has a spouse, so he's able to also reap the benefits of just a tax code. And I think now that his portfolio has now just really grew because he sold some of the low yielding stocks and he purchased more of the high paying stocks. That's my strategy. I want to do 25 years down the line. But now I think his portfolio is paying over 100,000 passive income, and he doesn't have to work, so he can do a YouTube video, make money off passively from YouTube, and then also reap the benefits of his dividend growth portfolio. So that is my goal. That's what I'm going to show you guys. This is the dividend snowball in 2K, 4K, 6K, whatever you want to see. It's uh the last video. It was just keeping it simple, invest into vote into QQQ, and then just call it a day. With this strategy, yes, it takes more research. It takes more you paying attention to your portfolio. It takes really high conviction and investment into companies on a day-to-day basis that you have high conviction for. If you don't have high conviction in oil and gas, or if you are a environmentalist, then you're not going to invest into uh, probably Target because the whole squabble that Target had. Or you're not going to probably want to invest to ExxonMobil or Chevron. Or if you are big on health, you probably want to invest into McDonald's or Ultra Grip Mo, which is the tobacco company. It's whatever you want to do as an investor, as a uh, as a independent investor. But we're here to get this money. We're here to create generational wealth. Hope you guys enjoyed my video and understanding and seeing how how the dividend snowball effect, how it ramps up and how it produces and makes this wonderful portfolio that eventually, when you stay consistent on a month-to-month basis, can make you millions. Hope you enjoyed the video. Peace.